Good morning. Today I'm presenting a paper on assessing the financial stability of Mauritius by using inflation, GDP growth rate, and non-performing loans as economic indicators. This paper has been prepared by myself, Dr. Yuvraj Sunecher, my colleagues, Dr. Avisha Bagji, and Mrs. Vanita Duboria. When a financial system has effective allocation of economic resources, both spatially and intertemporally, and it is possible to operate all economic processes effectively, even if there are external shocks or economic imbalances in the financial system, this means that the financial system is stable. Moreover, the financial stability explains the conditions where the financial intermediation process functions smoothly and foster confidence in the operation of banking institutions and markets within the economy. It is important that the banks also remain vigilant to new emerging trends and challenges to the financial system of a country, which could undermine financial stability by devoting significant resources towards instituting robust surveillance processes which aimed to identify risks and take measures to prevent systematic disturbances. The problem statement here. In these unprecedented challenging times, the domestic economy has been operating well below productive capacity. Cautious spending patterns and economic uncertainty continue to impact both household consumption expenditure and private investment. Some of the major problems are inflationary pressures persisted in the year 2020 due to low international commodity prices causing weak demand side and mild cost push pressures. The impact of COVID-19 has caused a sharp decline in the GDP growth rate in the year 2020 as a result of the significant drop in the tourism sector, and the impact of COVID-19 has caused an increase in the ratio of non-performing loans in the year 2020. Objectives of this research paper is to investigate the influence of the inflationary pressure and its consequences on financial stability of Mauritius, to assess the impact on financial stability through Mauritius' GDP growth rate, to critically investigate the impact of non-performing loans in the economy and possible recovery mechanism to put in place in order to establish the financial system stability of Mauritius. Let's now look at the literature review. Financial stability is the most generally perceived as the stability of the financial institutions and financial markets, and not the absence of individual institutions' bankruptcy and or the volatility absence of asset prices. Financial stability indicators from the integrity of statistical indicators characterizing the financial health and stability of the country's financial system, its corporate sector, and households. Such like indicators have been developed by the IMF with the support of other international structures and IMF member countries. Several factors affect financial stability. So let's take a look at these factors. The first one is inflation. Inflation measures how much more expensive a set of goods and services has become over a certain period, usually a year. Inflation has plunged countries into long periods of instability. Central banks often aspire to be known as inflation hawks. Inflation is the rate of increase in prices over a given period of time. Inflation is typically a broad measure, such as the overall increase in prices or the increase in the cost of living in a country. New borrowers have higher default risk because they were not initially interested in getting credit, creating adverse selection problem for investors, which is called credit market rationing. However, investors will not be interested in providing loans for new borrowers, causing fewer loans in the financial market. As a result, a current increase in inflation rate leads to lower economic growth in the future and also affect the financial stability of the country. The second one is non-performing loans. The main role of the banks is to provide loans for businesses to invest and create jobs. Loans are also granted to individuals to buy a vehicle or an immovable property, construct a house, or finance studies. However, granting loans is not risk-free because banks are never certain of the business or individual will repay the loan in a timely manner. Meanwhile, non-performing loans are a major problem for the banking sector, both in the developed and developing countries. As a result, non-performing loans are under the eyes of government and banking management since they are considered as a salient factor that has caused failure and crisis in the banking system. This phenomenon is considered most crucial to countries that highly rely on banks, as monetary intermediaries that assign funds throughout the country's economy. GDP, the third one is GDP, the gross domestic product rate. GDP growth rate is an essential indicator of the economic performance of a country. It compares the yearly or quarterly change in a country's economic output to measure how fast a country is growing. The GDP growth rate is popular for economic policymakers because it's considered to be closely connected to key policy targets. If the GDP growth rate increases, it may indicate that the economy is overheating and the central bank may seek to raise interest rates. On the other hand, if GDP growth rate decreases, then the central bank will consider to lower interest rates and stimulus may be required due to a recession. A healthy GDP growth rate sustains the economy in the expansion phase of the business cycle as long as possible. Now let's take a look at the methodology adopted here for this study. To achieve objective of this study, some methods have been adopted for each objective. Time series data will be used to analyze the relationship between inflation, GDP growth, and non-performing loan on the financial stability of Mauritius. The sample estimation is 10 years. The data software package will be used to run the analysis because of secondary data approaches. Study employed descriptive statistics, correlation analysis, collinearity, OLS as data analytical tools for analysis. Let's look at the data analysis and the interpretation. The mean, the minimum and maximum of the z-score were as follows. The mean for inflation, GDP growth, and non-performing loan is given by these figures. The standard deviation of inflation, GDP, and non-performing loans also are provided. However, it can be observed that the standard deviation of the GDP is slightly higher than the mean, implying that the independence of the data is a bit more diverse as compared to other independent variables. Let's take a look at the correlation. The correlation between the z-score and inflation is negative. Z-score and GDP is positive, 0.5, and Z-score non-performing loans is 0.6, positive 0.6. Let's take a look at the relationship. The relationship between Z-score and inflation is 0.11. Okay. The relationship between Z-score and GDP growth is 0.52, and the relationship between Z-score and non-performing loans is 1.09, positive. So, as a conclusion, here we can conclude that the positive relationship between GDP and financial stability implies that an increase in economic growth rate will lead to greater financial stability of the country. Besides, the result also shows a positive relationship between non-performing loans and financial stability. As recommendation, the approach to the development of these measures of financial stability has changed over the years as the focus of concern moved from microprudential to macroprudential dimensions of financial stability. The main objective of macroprudential policy is to preserve financial stability. Therefore, this includes making the financial system more resilient and limiting the buildup of vulnerabilities in order to avoid or mitigate systemic risk. However, the macroprudential policy cannot be considered in isolation since there are important interactions between macroprudential, and monetary policy measures. Monetary and macroprudential policies interact with each other, mainly by the common transmission channel through the financial system and also through the banking system. Hence, the two policy domains can complement each other in order to ensure financial stability. I would like to thank you, all of you, for your kind attention. So this is the end of my presentation. Thank you very much.